Hey everyone, so here's a question I got on Facebook. Can somebody explain deferred tax, how I deal with it in the balance sheet compared to current tax in simple terms? Okay, so this is, I think, what is being asked. So basically this, look, if you've got a current tax liability this year of 100, then you would debit tax on your income statement as an expense and put the tax liability to the SFP. Okay, simple. And if you had deferred tax of 40, you would debit tax on your income statement 40 and you'd credit deferred tax liability of 40. All easy, but I know that's not really the problem that you're having, is my guess. Okay, so I think the problem you're probably having is where you get given a trial balance. And you could get given a trial balance with figures like this. So just focusing on the trial balance in red there, that tax figure there is actually where you made a guess last year and got it wrong. And all it's doing is putting it right this year. So when the tax figure there is a debit of 40, it's just an expense this year. Okay, you didn't put enough in last year, so you have to put it in this year. And deferred tax of 100 is already there. So what you do is you put those figures in to your income statement and balance sheet. So the tax debit of 40, when it's a debit, you just say, right, that's an expense this year. Okay, that's all you have to remember. If it was a credit, it'd be income this year. But anyway, debit, open it on your trial balance, tax, just put it as a negative 40 as an expense. Deferred tax liability, just pop it in, 100. Then in the notes, it will tell you, right, tax for the year is to be 110. Just do what we did last time. Say, right, 110 then, that's tax on the income statement, 110, that's my tax liability. Remember the 40 was from last year. That was just updating last year's. And then it says, oh, and by the way, deferred tax is supposed to be 180. And you say, oh, is it? Okay, so I just need to add 80 on then to deferred tax liability to make it 180, and I put 80 expense to my tax on my income statement because it's debit tax on the income statement, credit deferred tax liability. That's it really. I want to do one more with you just to show you and complicate it a bit more because I've made the tax this time, the opening tax, to be a credit. Remember, that's just last year being wrong. That just means last year we paid too much. So this time the 10 is income to us. We've put it as a positive 10 to our tax income statement. The 100 goes to my deferred tax liability, and then you look in the notes and you say, right, notes, what do you tell me? It says tax for the year is to be 90. You think, right, that's my normal tax expense and my tax liability. And it says deferred tax is to be 80 this time. So I've currently got it in 100. So this time I'm having to reduce my deferred tax liability by 20. And so therefore I'm going to reduce my tax charge on my income statement as well. So that's again a positive 20. So your tax on your income statement in the end would be negative 60, I think. That's as complicated as it can get. So just remember then, when you see on your trial balance, when you see tax, all it's saying, when it's a debit, that's just last year's error, that increases your tax this year. And if you see it as a credit, then that's, if it's in here, then that decreases your tax this year. And then as far as deferred tax is concerned, all you do is you just keep it up to date. You're going to have a brought forward figure, a closing figure, just put the balance in, okay? If you increase the deferred tax, it's an extra expense. If you decrease the deferred tax, you treat it as income. I hope that answers your question. It might be that you're asking how to calculate deferred tax. Again, not difficult. I'm happy to do a video on that if you so wish. But anyway, hope it helps everybody.